Welcome back to the Microlearning Institute. In this tutorial we look at a question called a renta. Now a renta's functional currency is the dollar, but a renta has an overseas subsidiary called REMA, and we've been presented with REMA's statement of financial position at the 30th of April 2014, and this is presented in euros. We've been given the exchange rates, and the question asks us to translate the financial statements of REMA for the purposes of the consolidation exercise for the year ended the 30th of April 2014, showing and describing all the movements in the group's equity and retained earnings as a result of the translation exercise. So the first exercise we've got to do is look at the exchange gain on the translation of the net assets. Now, when we're doing this, we're looking at the net assets of the overseas entity, in this case it's REMA in euros, and we're translating those at the appropriate rate to the functional currency of our renta in this case, and we're identifying if there are any movements on the translation of those net assets. So we're given the statement of financial position of REMA, and in euros the closing net assets of REMA at the 30th of April 2014 are 1,043 million euros. We're also given a statement of comprehensive income for REMA, which tells us that the profit that was earned in the period ending the 30th of April 2014 is 243 million euros. So therefore we can conclude that the opening net assets were 800 million euros. Now, applying the rules of IAS 21, we translate the opening assets at the opening rate, and again the question tells us that the rate on the 30th of April 2013 from euros to dollars was 3.5 euros to $1. So therefore the opening net assets of REMA translated to dollars translates to $228.6 million. IAS 21 tells us that we translate the profit figure at the average rate, which again we're told is 3 to 1, so the profit translates to $81 million. So consequently we expect the closing net assets figure to be $309.6 million. That's the sum of the opening net assets plus the profit. However, when we translate the closing net assets figure of 1,043 million euros at the closing rate, which is 2 to 1, we see that it translates to $521.5 million. So consequently we have an exchange gain on the translation of net assets of $211.9 million. That being the difference between 521.5 and 309.6. And that exchange gain is one of the movements that we must consider in the consolidation exercise. Next up, we look at the post-acquisition reserves. So we're given the statement of financial position of REMA, and again in this statement of financial position they have given us the post-acquisition reserves of 776 million euros since acquisition. So we need to translate this statement of financial position now, and again using the rules of IAS 21 we translate the closing assets at the closing rate applicable at the 30th of April 2014, and this is 2 to 1. So again the 1,582 million euros translates to $791 million. Similarly, the ordinary share capital is translated at the rate at which it came into existence, and of course it came into existence on the incorporation of REMA, and on that date we're told that the rate was 4 euros to $1. So the $267 million translates to $66.75 million. Similarly, the non-current liabilities and the current liabilities, IAS 21 tells us that they're translated at the closing rate, and here we see them translated. So now the retained post-acquisition reserves are a balancing figure, because of course the total assets and the total liabilities and owner's equity of our balance sheet need to both add to $791 million. So therefore, as a balancing figure, we can say that the post-acquisition retained earnings translates to $454.75 million. Thank you very much for watching this short tutorial from the Microlearning Institute.